And then Wednesday was the day we've all been waiting for, Fed Day. MBS were up 9 basis points on the open. The 10-year was down 7 basis points. Bonds were almost perfectly flat in Asia, then slightly stronger in Europe. Notably, EU bonds were pulled back into negative territory early this morning while U.S. yields remained a bit lower. ADP data clearly delivered a jolt of volume and a smaller jolt of directional trading. All in all, the move was worth less than 3 basis points to the 10-year, but it was in the right direction. ADP employment showed 106,000 job creations versus 178 forecast and 253 last time. So that's a big difference, and hopefully will help out with inflation. We hate to see people not getting jobs, but we need this for inflation to stifle. Most of the growth came from the hospitality industry, which added roughly 95,000 positions. Then we got the JOLTS, the job openings and labor turnover survey, which came in at 11.01 on a 10.44 previous. So that one actually went back the opposite direction. Pay growth was plus 7.3% for job stayers, plus 15.4% for job changers. Leisure and hospitality saw increases of about 10% and was the outlier compared to the rest of the sectors, which were bunched between the 6.6 and 7.9% gain. This is something that will bother the Fed as services excluding housing is their target for inflation reduction. The youngest cohort, 16 to 24, saw the biggest wage increase as well. So what we're seeing wage increase, which is going to help people pay those credit cards that they're racking up. But also this is a skewed stat because this is a lot of part-time hospitality young people where they're going from, $8 an hour to $8.50 an hour. We were pretty sure we knew what the Fed was going to do and say what Powell was going to say today's press conference. He turned out to be generally predictable. After all, we're really only two things we're looking at the Fed can say right now is we still need to see more progress on inflation, and B, we will determine when the job is done by data. So data is going to determine it. Despite Powell's unsurprising comments, the market was apparently surprised or relieved. This is surprising considering the simple list of routes the Fed had in its playbook. Perhaps it's as simple as the market being overly prepared for a hawkish smackdown from Powell and instead got a logical approach. At the end of the day, we came in at 101.75, which was up a quarter, which bounces us actually up into that new range. We've been bouncing off the ceiling at 101.671 for, what is that, about a month and a half now. So that busts us into the new range, and it looks like it even made a run at the 200-day moving average at 101.937 before resting in. Have to see if tomorrow the range holds on that. The spread between mortgage rates and the 10-year Treasury has been abnormally wide since 2022, or at least early 2022. Further narrowing of that spread is expected to put downward pressure on mortgage rates in the coming months. This is the good news. So as everybody feels like they know what the Fed is going to do, there's a chance where rates could narrow down and your MBS rates can come down closer to the Treasury rate. So that would be much needed. This is why a lot of people are thinking rates will come down to the 5 sometime fairly soon. We did get some info from MBS spreads yesterday, courtesy of AGNC Investment, a mortgage REIT, which announced its fourth quarter results. Mortgage REITs invest in mortgage-backed securities, and they are often the buyer of Fannie and Freddie securitizations. Think of them as the ultimate lender for your production. For the past year, the mortgage REITs have been reporting declines in book value as MBS spreads have widened. So as these have widened, they've had to state down and make it look like they are making as much money or holding as much money. In other words, MBS have fallen in value with interest rates, but the hedges mortgage REITs have used have not increased in value enough to make up for the losses. So this is a big problem for mortgage bankers because the items that they're using to hedge your loans while you are processing them are not matching up with what the actual prices you get at the end are. So that's a big problem. So hopefully with some stability, we can get that stuff worked out. This spread increased significantly in 2022, which exacerbated the increase in mortgage rates from 3.27 to 6.66%. 666. Terrifying. Oh no.